takeaways on the minutes and really all the Fed speak that we've had lately, where Fed members, it sounds like, are getting a little itchier to move faster to fight inflation?
Yes, I think Fed members are saying to themselves, look, there are certainly transitory factors, but it's taking longer for them to dissipate. And there are also some factors that may be more persistent. Given that, we see very elevated levels of inflation, just this morning's report for the PCE headlining core. Plus, we're seeing a strengthening labor market, very strong October payrolls, very low unemployment claims, and also very strong GDP. And certainly when we look at consumption spending today, people were spending on both goods and services. So we're really shaping up into something that looks like a backdrop that looks like we can begin normalizing or raising interest rates.
Mona, what's also notable is market reaction, which is not a whole lot. Yes, the NASDAQ is looking at a 1.5% drop for the week. Rates are a little bit higher this week across the board. But there's a lot of talk about faster taper, including from Mary Daly, the San Francisco Fed president, who I look at as a very dovish member of the Fed. And if she's talking about it, clearly the center of gravity is moving here. And the market doesn't seem all that concerned about it. Should they be? Should investors be?
Look. Yeah, I think there has been a little bit of market digestion of this new normal where we have been hearing from Fed governors about maybe accelerating the taper. We have been seeing in the markets pricing in 2 to 3 rate hikes next year. We're seeing the 10-year yield move higher. So, in September it was a 130 range. Now we're at 168 or so. But, I think what markets are also considering, one, in terms of the Fed, keep in mind, it's not only when they start to raise rates, it's how high that terminal rate goes. And we do think this cycle could be a little bit shallower than what we've seen in the past. So the past 2 cycles, 4.25%, 2.25%. This one could be maybe in the 2% range or so. So much more palatable, much more digestible for markets broadly. Also keep in mind, we still think we're very much in the middle innings of this economic expansion. So yes, next year will be slower growth, but above trend GDP growth. Earnings growth will moderate. We had 45% plus this year in the S&P earnings growth, but next year we could get high single digits. And so that backdrop still lends itself to the continuation of this bull market. Could we get more volatility? Yes, we're already starting to see that. We do think in the near term, the value cyclical trade has some legs, given we see rates grinding higher, given reopening 2.0, we think will still continue to happen. But longer term, as growth kind of normalizes and maybe even goes down a little bit, those tech and growth stocks come back into favor as well.
Dana, as we all prepare for the moment when the Fed is going to get more fully into inflation fighting mode, I wonder how the next few months worth of data are going to play, because almost everybody would expect inflation readings to be high on a year-over-year basis for the next few months, just because they're going against very low ones. So it's not until maybe March that we get some better sense of what the overall trend might be, at which point, who knows what we're going to be looking at in terms of growth. We're going to have some fiscal drag. So I wonder if you believe that the Fed is still in that mode of saying, we'll get the taper done and then we're going to be agnostic and wait and see? Or is the market correct that in May we're likely to already have the first rate hike?
I think markets are correct to anticipate 2 or 3 rate hikes next year, certainly early spring. Let's look at the fourth quarter. We're probably going to see growth in around 5%, maybe a little bit slower in the first quarter of next year, certainly if we have another round of COVID infections. But certainly once we get into the second quarter, very strong growth. We're anticipating that inflation is going to probably peak in terms of year-over-year rates in the fourth quarter, but still remain quite elevated. And let's look at the labor market also. If we're adding roughly 500,000 jobs every month, we continue to see unemployment rate come down, and the participation rate may be a little bit sticky, certainly as many people are retired. We're probably much closer to full employment. So I think the Fed can certainly be positioned, especially if we do see somewhat of an acceleration and taper, to be ready to start raising interest rates by the springtime of next year.